When there is a demand but a supply as well, most traders don't know which one matters. If you're trading the demand, what levels are you targeting? And if you trade the supply, what levels are you looking to target? Let's jump into the video and explain how it's done, and the mistake most traders make when they face this situation. So if we quickly check on this market, we had an uptrend, and this uptrend looks like it's reversing into a downtrend since you can clearly see this entire bearish price action. This bearish pressure has broken below the last low of the uptrend. Therefore, we would call this a trend change, since we know that an uptrend is formed with higher highs and higher lows. And the moment we get the first break of the last higher low, turning it into a lower low, that specific first break signals a trend reversal from a previous uptrend into a highly likely upcoming downtrend with their lower highs and lower low formations. They're pretty basic market structure concepts, and as you know on downtrends, we identify supply zones from where we can sell the market down. This, for example, being a supply. This supply filled right here and gave the opportunity for a sell setup, and this happens not once, but many times the market has an impulse to the downside that forms a supply. For example, here we have another one. So let's try again with the same logic. Sell short on the supply, stop loss above the supply, and for the take profit, let's place it below the last low that was created recently, having a 2.4 ratio, which is not bad at all. And we do nothing until the market hits the supply, so we just need patience. And what I'd suggest is placing alerts on important levels. In this case, we filled the supply a few hours later, opening the position but quickly losing this setup, closing on the stop loss while the most recent price action is looking very bullish. So the question is, what was the mistake? What did we do wrong? Was this only bad luck? Because from what we have, this was a clear and simple downtrend, and a couple of supply zones that validated and worked before. So why is it this time it failed to respect like it did before? Well, from the highest point we started pushing down. Then we get this bullish impulse out of nowhere. The best question is asking why did it bounce from here, and why this was the lowest point we had. And oftentimes it's because this level filled a demand on the left. Demand that we did not see because we skipped analyzing the market, or simply we just didn't zoomed out in price enough for those candles to become visible. Because if you check on the left of this bounce, there is bullish pressure. And if we zoom out even more, we see that this market came from a downtrend, then reversed to the upside with a trend shift. Now, the moment the trend shift confirms by breaking the past high, that's when a demand zone validates. The demand being the last bearish candle right before the price started aggressively going higher. And if you look closely, this bounce ended exactly on this demand. So the downtrend that we knew, this descending price action, it only looks to be a pullback of a higher time frame uptrend, pullback to fill a demand, so the market can continue into breaking the swing high. Would be similar to this type of price action where we had a swing push to the upside to form the high, then a swing pull to the downside to form the swing higher low, then continuation from a demand zone to form the higher high. The mistake was ignoring the external price action, because it's true that during these levels we could have sold short with winning setups. But as we kept selling each supply, we ignored the fact that we were approaching an external demand. The higher time frame or external demand gives a huge opportunity for a swing setup, a buy position to be more specific, structurally with the stop loss below the demand. And the take profit placed with a market structure logic should be right above the swing high. With this setup, we're saying two things. We expect this low to be the higher low of the swing level, and we expect the past high to break to the upside, hoping for bullish continuation. The risk-reward ratio can get quite high in some of these setups, but it takes a pretty long time for them to print these opportunities. So these are more a swing type of setups, since you might be a few hours or few days still with the open position. This time on another market, we start by marking the swing low and the swing high. Everything in between is the internal price action. For example, if we zoom into the internal price near the swing low, there is a reversal from a downtrend into an uptrend. The reversal happens when the market breaks above the last high. This break by forming a higher high, it validates a demand zone, demand that filled on the next internal pullback. But the thing is that you never know if this demand could still fill later from a high time frame pullback to the downside, especially knowing this is the lowest point we had recently right before the market started this uptrend. Now we're going to zoom out so we can see the swing high as well. Before marking the swing high, we obviously had this uptrend that was pushing aggressively from the swing low. The last upside push was followed with a pullback to the downside that was much larger than the previous pullbacks. For example, look here, and here as well. So the pullbacks were a lot smaller compared to the last one, and that wouldn't be a big problem if the market could have continued to push higher and break above the last high. but that didn't happen. And instead, it pushed to the upside but quickly faded down, starting to form lower highs, and shortly after the lower lows came as well. By breaking below the last low, the trend changed from an uptrend into a downtrend, but keep in mind that it's a trend change of the internal price action. Because for an external trend change, the market would have to break below the swing low, and it's only then when we would say that this market is external bearish. But until that happens, we are in an external uptrend that's currently having a pullback, and a pullback of the uptrend is an internal downtrend. Now on the last candles we're seeing a pullback to the upside. The higher probability for this pullback is to end with an internal lower high, so it can then follow the downtrend with an internal lower low, basically breaking the last low from here. And that's pretty much what happened. We got the internal bearish break. Now after a bearish break, we expect a bullish pullback. This pullback is there to fill a supply from where it can reject. This is the case if you are trading the internal price action. And in this case, it can be traded. And the reason is because we are still pretty far away from the swing low. So from this internal pullback to the upside, you want to identify a supply should be the last bullish candle before the market started gaining bearish pressure. This might be the level of the supply, also being the highest point of the internal pullback. Now, if we place a sell setup from this supply, you must know what levels you're going to target for the take profit and stop loss. Let's see all logical options. One option would be having the stop loss above the swing high, but this doesn't make much sense. You're basically saying you're expecting this supply to invalidate, so you are essentially expecting to snipe the exact moment the internal trend is reversing into an uptrend. Because if we break the supply, we form a higher high on the internal trend after having lower highs for some time, that would be a trend shift. The problem with this placement is that you're having the stop loss based on the external price action, but the entry is placed based on the internal price action, so where would the take profit have to be placed so you can get a good ratio? Even if we place the take profit below the swing low, the risk reward is quite low. The other option for the stop loss is right above the internal supply. Now we need to ask if the take profit makes sense because right now it's below the swing low. And remember that on the swing lows we had an external demand. The problem with this take profit is that you're trying to predict the trend change from an external uptrend into an external downtrend, and there are no strong signs that this market is in a downtrend. Sure, the most recent price is bearish, but this bearish price action could be a pullback of the external uptrend. So, with this take profit target, you're trying to snipe the exact moment of the reversal, which doesn't make much sense. Instead, a safer alternative for the exit target would be right below the recent internal low, which is also above the external demand. So in case the market hits the demand and continues the external uptrend, you would be already out of the position since it hit the take profit before filling the demand. And in the case the market actually reverses into an external downtrend, you still end up exiting with the take profit. So it's a safer alternative since you are internal bearish, which is following the trend rather than trading against it. We got the fill of the internal supply, very close to hit the stop loss. Then bearish pressure kicks in from the supply, closing on the take profit. Now it won't matter if the market continues the external uptrend and breaks above the last swing high. Also, it won't matter if the market breaks below the swing low and we enter into a bearish external trend because this position is already closed. What's coming next matters only if you plan to look for another setup shortly after this one, which is a thing I usually don't suggest. The best thing to do after a winning setup is to leave the charts and come back another day because you don't want to give your profits back from greed and impatience. And if you want to master all these concepts, feel free to check out the link in the description, and I suggest you watch the last video because it complements what we used in this one. Have a great trading week.